Hey, good afternoon. Welcome. I know everybody's had a fabulous day here with Berkeley. I am very, very pleased that I get to have a chat with Lila Preston, who is the head of the Growth Equity Fund at Generation Investment Management. And we are going to discuss how companies and investors should address ESG going forward, 2021 and beyond. And I think, Lila, we will start with you on a personal level. Who are you and how did you get into impact in ESG?
Thank you, Suze, and really happy to be here as well. So we're looking forward to having a conversation. My journey did start quite early. I actually, in undergraduate, studied both literature and Latin American studies, and it led me to Southern Chile right out of school with a Fulbright fellowship, working on community-based conservation and forestry projects in that Southern cone. And I think from the very early stages, the intersect between climate and community and how finance could be used as a lever to help scale impact. And so I journeyed back to the Bay Area right at the cusp of the dot-com boom bust cycle, and was very lucky to get into a role within finance, but in the social enterprise space, learning from some of the early pioneers like Sarah Olson and Jed Emerson, and recognized at a certain point I should invest in my own skill set and put myself into business school, actually in London. So I ended up at London Business School. And during my second year, I was leading the Net Impact chapter at London Business School, which many at Haas would know as the Students for Responsible Business back in the day. And I was introduced to a guy named Jason Scott. And Jason was one of the early employees at a new firm called Generation Investment Management. And it had some really impressive founders, but at the time, zero assets under management. So it was a big idea, a big ambition to put sustainability at the heart of an investment process. And I found that, for myself, having started literally with my hands sort of in the dirt, doing reforestation projects with native species and working in communities and kind of taking these incremental steps to seek impact at scale, this was an extraordinary opportunity. And so I joined from a project in 2004 to a full-time employee in 2005. And since then have worn many hats, first as a thematic researcher, then as a consumer analyst on the public equity strategy, and then today really dedicated to private equity, which I've been doing now for almost 12 years. So that is my personal journey, and I hope that you can also share yours too.
That's amazing. And at some point in there, I think when you got to Generation, we had the opportunity to meet, and now we get to work together, which has just been fabulous. My background is I was a normal corporate lawyer. I think I always liked the outdoors, but my sustainability and focus on ESG wasn't grounded in my education. I actually, as we are just post-election, I grew up in rural North Carolina as a Republican, and always appreciated the outdoors, but really liked economics, like structuring deals. I went to work in New York after law school. I then came to Morrison & Foerster in San Francisco. And in 2001, two things happened. Number one, the economy completely tanked, and I had time to actually look around and not just do deals. But number two, my husband had become a Presidio park steward and was actually restoring the Presidio, which is right out my window here, back to its natural state. And I had the time in 2001 to meet fabulous people who are working in sustainability and climate, and I saw it. So I guess I saw it a little bit early. And I think I've talked to you before, it was like taking the red pill. All of a sudden, when you see it and you see the impact, you think, oh my heavens, business investment companies are going to have to fundamentally change. And from then on, it started pro bono. I'm doing a lot of work for TNC, and now it is a lot of paid and pro bono, still working on really how do you do what Generation is doing? How do you take this out of the world of philanthropy? Philanthropy is important, but how do you take this into the mainstream capital markets and really change how business and investors invest and operate so that they consider sustainability and impact in ESG? And that's why, Generation was a big idea and was one of the first in this space. And I know that you're in the public markets, but you had the Growth Equity Fund. Can you tell us a little bit, especially now that you have fund too, kind of how your investment thesis around sustainability has evolved and where and why you're focusing now, I think, on on sort of the positive, looking at a company's overall operations and the positive impacts?
Yeah, absolutely. So for those of you who aren't as familiar with Generation, it's an investment management firm that was set up again in 2004, putting sustainability at the core of its process. So today, Generation manages over 25 billion of assets on behalf of institutional clients principally. And that is across both listed equities and private equity. And we have now, we're actually in Fund 3, the Sustainable Solutions Fund 3, which is really our private equity activity seeking to accelerate the transition to a more sustainable economy. And we look at that across 3 pillars. We talk about planetary health, people health, and financial inclusion. And within planetary health, this is accelerating transitions in mobility, energy, food and agriculture, the other built environment, and so on. Within people health, it's looking at improving health outcomes with more affordability and broader accessibility. And then financial inclusion is broadening access to finance as well as a equitable future of work. So these are kind of 3 often in overlapping spheres that we look at. And we talk about this in the context of system positive. So you're right. I think this it is critical to understand how companies not only will thrive in this transition and how sectors are developing, but also drive sector development and transition. And so I think if you think about us investing behind, thrivers and drivers, especially on the private side, where we can meet companies early in their evolution, that ability to shape, their products and services, how they operate as an organization, and ultimately map that to where, industry needs to go to meet the sustainable development goals. And so for us, it's always been clear that this transition that is taking place now to a net zero, prosperous, equitable, healthy, fair, and safe society that is required is going to take an enormous amount of innovation and disruption. And with that disruption comes the need to rewire entire industries. And so we think about this as a deep opportunity set for us to do both the private and the listed investment.
So looking at both, and what I hear a lot is that people are both, and may start with assessing risk, of course, the risk associated with climate change, but also looking at the opportunity at how companies and new technology and new ideas can really shape in your 3 verticals, and looking at the overall impact of a company.
Yeah, I think often we get asked, because 16 years in, sort of what's changed. And, there are many new ESG funds that are coming into the market. I think I've cataloged, 6 new $1 billion funds in the past 6 months, which is extraordinary and really exciting to see. And for what has changed for us is the sense of urgency. So I think now, this is not a time to be casting doubt on others' intentions. It's actually to say, we accept the intention, now let's put it into action and let's be collaborative and collectively more aggressive together. I think for the market, there are more people in the room in 2020 than there were in 2004. It was a little bit lonely back then. I think, there's safety in numbers, but I actually think this is because the economic opportunity is showing. And what's also changed is this clear recognition that all companies have impact, positive and negative. And many of the largest institutions, endowments, family offices are now on this journey of understanding what that means for investment performance. And so, as you cited, Suze, many first start with risks, looking at how a company operates, the ESG risks, and then how to mitigate them. Pretty soon after, you look at the opportunity side of how a company operates. So how you can drive energy efficiency savings, how you can improve supply chain, how you can invest in people and culture. The opportunity lens just makes sense. But it is just as important, not just to understand how a company operates, sort of the base ESG profile, but also what a company does, its products and services. And effectively, as they sell more of these products and services, how do we track and understand the ultimate contribution to the Sustainable Development Goals? And, for companies in the environmental sectors or related to heavy industrial or even light industrial, you have to ask about their scenario planning for, a 1.5 degree world, the TCFD, engagement related to that, as well as setting science-based targets. For all companies, we should be asking about Scope 1, Scope 2, and Scope 3 emissions, and understanding how their products, for example, may be net beneficiary, drawdown solutions, or if not, actually understand how they're going to generate economic value over the long term if they're not doing so. And I think, the critical lens of not only what a company does, but how a company operates. And sort of that's necessary, but again, not sufficient, because a final layer is this company level analysis matched to industry trends. And we'll talk about the sustainability trends report, but effectively we want to know where a company sits in a value chain and whether that spot in the value chain will be supported or impaired by a transition to a net zero future, for example, and understanding the systemic shifts that are taking place. And so that industry analysis is really critical. And we think that our form of talking about that is industry roadmaps. Generation's done some 280 of these since inception, but it looks around the corner. Again, it doesn't do backward-looking ESG analysis, but rather mapping it to what are the future requirements in industries, again, such as transportation, energy, food and agriculture, financial services, healthcare, and so on.
And the key, I think, there is by industry, because, comparing so somebody is having a positive impact. And I like how you framed it. You have to sort of look at the good or service they're producing, but how they operate internally, and then put all that together when you're looking at the system's positive. But it is industry by industry. So when you compare,
Right.
a technology company with an industrial, how are they doing? How are they deploying capital to really have impact is key. I do want to go to the sustainability trends report, because first of all, both of us were there, 20 plus years ago, and it's interesting. The market has evolved, and you have been one of the players that has really encouraged others. And I think your work on the sustainability trends report really is for the whole industry. It's like, okay, we've been in this space, we understand it. We want your contributions, but we also want to help you, the rest of the investment community, understand what we are seeing. So if you are investing, what I often say, for impact, so you're looking at a good or service that is positive, or you're investing in the rest of the economy, kind of how you should be thinking about these trends to really see around the corners. Do you want to tell us a little bit about, just give us the preview of what's in the report for those who haven't read it?
Absolutely. And a fair critique of Generation in the first decade was that we did all this deep research and these roadmaps, but we weren't, shouting about some of the findings. And in many respects, we recognize that more and more voices needed to share what we're seeing on the front lines and in these different pockets of the market, whether it be in, plant protein adoption trends, or it be in, electrification of our vehicle fleet. I mean, some of these are no longer new, but actually when we started 4 years ago with this trends report, we were stitching together both the picture of tailwinds and headwinds associated with adoption curves. And so this is an annual process. We actually release it every sort of June, July period. So we just released 2020. It calls on some 190 different sources, again, distilled across kind of sectors, to show in pictures, for the most part, sort of like Mary Meeker's Internet Trends report, the sustainability trends that we see shaping industries. And really, this is a combination of cost down curve analysis, consumer demand shifts, policy changes, societal expectations. And we were catching, both COVID and then Black Lives Matter into the 2020 report. And I really encourage folks to take a look. If you have some time, it's on our website and open access, downloadable and shareable. And if you see great stories about what's happening now into 2021, we'll be collecting those images and pulling them together. So for example, I guess 2 years ago, we were looking at that milestone of 5 million, electric vehicles on the road, or plug-in electrics on the road. And we saw that 17 nations had set dates to phase out the internal combustion engine. And, this year we picked up on that to show penetration of electric vehicles in certain Nordic markets at around and above 50% already. Again, very much early mover markets, but a recognition that over the next 5 years, over half of our global bus fleet will be electric. Again, much of that is due to advances in China. And yet, if you look at the World Health Organization, they will remind you that more than 90% of children still live in cities with toxic levels of air pollution. And we saw a disproportionate impact on communities of color from COVID with respect to air pollution and then the respiratory challenges. So, this is definitely kind of 2 steps forward, 1 step back that we get to catalog. Again, in 2020, we saw the rise of telemedicine, remote working, and we tried to catalog corporate commitments towards net zero, which I think we've seen really in full swing this year. And I do believe that we're hopeful that as we talk about 2021, that some of those move into action.
It is. And from my perspective on the trends, it is interesting to me that, even though we're in sort of financial duress and the economy is not going to be booming anytime soon, the companies and investors are increasing their commitment to ESG, and particularly on climate. We're actually seeing more and more people who are saying, actually, focused on climate, focus on ESG actually means resiliency. And there's some data to support the fact that investments in this area actually are, have better returns because you're thinking about what happens. You're looking at the trends, for example, in your report and saying, okay, no, this is going to help us. The information here is going to help us make decisions. What I'm seeing sort of from a legal perspective is more and more people are kind of looking at how to aggregate capital. So they're looking at fund structures and impact capital managers where you and I work with. We actually are working on a study with Stanford of all the different ways to sort of bake in. You have a 2 and 20 fund, which works, but what are the pros and cons of the permanent asset vehicle, the generate capital type model? What are the pros and cons of a platform like the one MacArthur and Rockefeller set up for impact of stimulating mainstream capital? What are the pros and cons of having a public charity within your GP, of structuring carry to match impact? There's a lot of work that's been done there. There's a lot of work been done in terms of deploying capital, the debt and equity instruments themselves, whether it is SDG performance-linked bonds or the new FAIR instrument, which is a variation of a SAFE for an early stage with a focus on impact. And there's a lot more. I would say most of the activity is at the company level, where focusing on stakeholders, shifting fiduciary duties, people call them B Corps. Remember B Corp not being a corporate form, but the PBC. We have 3 public companies that are now public benefit corporations in Delaware that have gone public. Again, you take a mission and you change the scaffolding around a company, and you can affect how it operates. So it's an exciting time.
We see more and more interest and appetite in this. And so to the extent that those case studies start moving from the ones to the tens to the many, I think we're actually at a really interesting inflection point. Certainly now, many companies that we get involved with that are, again, hitting a level of maturity, we're providing growth capital. So somewhere between $50 to $150 million to growth companies that are really move past technology risk or product market fit risk in their kind of market penetration stage. That they're putting their hands up already as certified B Corps, but on a journey to think about what their future, corporate form should be. And in that instance, I always pick up the phone and call Suze and have them have a conversation with her, because it's really critical to understand the variety. And then at this, when do we start to see repeats of what's working? And actually, Suze, I'd be really keen to understand, are we starting to see, these examples where many companies can pursue, the public benefit corporation you've talked about, as kind of beacons or watch outs of what risks might be inherent in them as well.
Right. And I think this would be a good time. I'd actually like to turn it back over to you and talk about just a couple examples of companies that you think are doing well. And then I'll give you 1 or 2 examples where we can learn from kind of what's happening, how we're using these forms going forward to affect change.
Yeah, so a company that Suze also knows well, but one which really is a great example of the transition to a lower footprint agricultural and food system is a company called Nature's Find. It's a business that we've tracked for many years. It is actually on the earlier stage, but given we've known the company and done probably 8 roadmaps in agriculture and food, we are very excited about the ability of nature to deliver better protein sources. In this case, it's a nutritional fungi protein, which requires a fraction of land and water consumption for production. It's a microbe that came out of the geysers of Yellowstone and is now, through surface fermentation, able to move into a suite of consumer products, and the company is scaling up. Another example would be actually in the financial inclusion bucket, a company called Remitly, which is delivering digital transfer services to principally immigrant families, both in the US and internationally, to send money back home. You wouldn't be surprised, but it is extraordinary during times of such unprecedented volatility and then lockdown of borders that, there has been a rise of people needing to get money back home. And so a company like Remitly, which delivers a low cost, transparent, trustworthy, and safe way for money to be transmitted, has really seen, important tailwinds. And I think it's really critical that companies that have products and services that are relevant towards the Sustainable Development Goals are also showing up in the world about the how of like recognizing the important moment of our societal need for both transparency and commitments to addressing racial bias. And I think that's kind of what we're looking for, not just that products and services are mapping to SDGs, but then again, companies are being really authentic and committed in addressing kind of broader actions towards their commitments in society. And so that's another example. We have, companies in places like Africa, like Mcopa, that's delivering off-grid solar and other consumer electronic products into the home. Again, taking people who are off-grid and enabling them to have solar power for their home lighting needs, displacing kerosene, and also bringing them into the financing system through micropayments. So these are companies that sometimes you ask, is it in the planetary health, the people health, or the financial inclusion bucket? And in many cases, it could be all three. So we think that's exciting that in many respects that we're not being as siloed thinking as often we were maybe in the past 2 decades. I think climate does have a lot of prominence in the sustainability agenda. However, we need to make sure that climate is twinned with the important health and then, kind of just transition requirements as well.
No, I agree. And I think you and I have talked about this before. 10 years ago, you had 2 distinct groups of investors in companies. You were either people or you were planet, and you sort of waved at each other across the room. Yeah. But now I think, particularly with COVID, I think there is a clear recognition that the communities that are being significantly harmed by COVID are exactly the same communities that are going to be devastated by climate. And so how do you come up with solutions to solve it? I'll provide kind of 3 examples on, sort of mirroring to the corporate form. One is sort of a grassroots effort that has taken off and now has become the fund for the state of California with philanthropic capital, state capital, hopefully federal capital at some point, and bank debt, where we're aggregating capital to lend to CDFIs, to then on lend to businesses in our poorest communities in the state. And these are microloans, and it's $1 billion fund, and we will have our first close in the 200 million range. So, and from a corporate forum perspective, this was the first time we have ever structured something at scale that is not a fund, like it's an RIA, a registered fund, which is aggregating capital, which is kind of, you have all the costs. It's not good or bad, but you have all the costs of running, that kind of entity versus bundling and selling the loans themselves. And you just have to look back to 2008 to understand kind of some of the risks associated with that. This is a PBLLC that sits under a public charity and then on lends. And so it's the first time we're trying this at scale. Another good example is TCE, which is the Climate Endowment, which is the big coal deals I've been working on, which is a joint venture, and it's a PBC and a public trust to offline coal reserves at scale. So that has a lot of potential. And then a company like Lemonade, as I mentioned before, we have 3 companies that are now Delaware public benefit companies. So the boards and management have a fiduciary duty to an agreed mission or goal that are out now trading in the public markets. And I think I agree with you, as soon we'll have 10 or 20 or 50 or 100, and that can be a game changer for new companies, but also for established companies that want to go this direction. So our last question here, Lila, is okay. We were asked to talk about sort of 2021 and beyond, but I feel like with COVID, I live a day at a time. I live a day at a time, homeschooling 3 boys and trying to work at home. But really, for the next 12 to 24 months, what do you see as kind of the biggest change or the biggest shift that we're going to see around ESG and sustainability?
So there is still so much uncertainty. I do think there's sort of like a moment to breathe, and we can have maybe more excitement about both Paris and beyond from a climate commitment perspective than even when we were debriefing for this panel, a week ago. But I think if you go to the commitments that have been made in 2020, we have to shift from commitments to action. So, Net Zero Alliance, companies setting science-based targets, putting a price on carbon for internal use. And this, is necessary but not sufficient. So now we need to kind of pull a pretty significant sort of like bend it like Beckham curve. If you look at the emissions trends required to meet the 1.5 degrees C pathway, it's 2020 is it. Like we're now eclipsing the point where we need to be in serious reduction path. And I think for me, what gets me excited is that I do believe that we can do that. I do think it's going to take a lot of both sacrifice, energy, effort, and hopefully we keep this health and communities piece twinned with climate. And so for me, I want us to start to see the action points around the commitments. And then importantly, I see the sun is coming out onto my face as I speak. This is like, gets me really excited. So this is, for me, the end of do no harm or business as usual. So it's just not going to be sufficient to say we're not making it any worse. So coming back to the system positive, from our perspective, it's the only alternative. And I would hope that fiduciaries and boards are asking that question around board tables, and we can start to see accountability and action off the back of that. How about you?
Really what I'm most excited about is the increased commitment, that it has gone beyond just having sort of one emissary or one representative on a board or management who sees it, to really a deep understanding sort of in the corporate law community and at boards and in management that we have to. It's not, are you breaching fiduciary duties if you focus on it? It's you are, breaching your duties if you're not considering these ESG factors, because they relate to risk and they relate to opportunity, and they are going to impact how the company builds. But I would say what I am most hopeful of for 2021 is we can break the whole what's the right word? Sorry. The whole construct where people make money and then give a little bit away on the side, where in fact we have to and can change how people make money, because these issues can't be solved with a little philanthropy on the side, with foundations that are funded with 1% of the profits. We have to fundamentally change how investors invest, and that's why I am honored to know you and to know the work that, to see firsthand the work that Generation Investment Management has been doing, but also how companies operate. And I think your system's positive approach is exactly right. You have to think about how a company is operating in its broader perspective.